Good morning, sir. My name is Pinsutema. I am joined by my team Kilitring, Pemazongo, and Sunum Belden. Now let me take you through the title slide. We are excited to walk you through the valuation and analysis of one of the world's most recognized company. Now let me take you through the outline of our presentation. Our presentation today is structured into four main areas. First, I will provide a company overview and explain our motivation for the selection. My teammates will then dive into the core of analysis, covering the valuation methodologies and key assumptions we used. This will lead us into our results and analysis, where we present the full TFC valuation and the resulting pro forma financial statements. Finally, we will share our key takeaways. Let's start with the company profile. The Coca Cola Company is world's largest non-alcoholic beverage company. Its portfolio is vast and impressive, consisting of over 200 brands, including core names like Coke, Sprite, and Fanta. It operates on a truly massive global scale, reaching over 200 countries via its unique franchise system, famously known as Coca Cola system. Now, in the fourth slide, let me state the challenges and motivation for the selection of topic. While Coca Cola benefits from stable, consistent demand and the industry is constantly evolving, a key challenge is the shifting consumer preference towards healthier options, which drives the need for continuous innovation in new product categories. The key growth drivers we see are global population growth, rising incomes in emerging markets, and the necessity of product innovation. We select Coca Cola for our analysis for three main reasons. First, as a market leader, it represents an ideal and robust candidate for discounted cash flow analysis. Second, the company offers high quality, consistent financial data that is publicly available, allowing for rigorous analysis. Finally, it remains a fascinating study in corporate resilience as a global brand that consistently adapts to local taste and changing market dynamics. Now I will hand over this presentation to the next presenter who will cover our methodologies and key assumptions.
To arrive at our valuation, we used discounting cash flow model as our primary methodology, under which we calculated free cash flow of the firm and discounted it back to its present value. Moreover, the supporting analysis is we did it on WACC, which is weighted average cost of capital, and pro forma analysis of three statements. Now, for the key assumptions, we have 5% of discount rate, that is WACC, and 2.50% of terminal growth rate, which shows the long-term growth for mature company. And we have 5.50% of revenue growth, which is the historical and market expansion, and the tax rate we have is 18.62%.
Now let me take you through the results of Coca Cola Company, WACC and pro forma analysis. Starting with our cost of capital, our resulting WACC is 5%. This relatively low rate is suitable for Coca Cola Company, reflecting its low-risk business profile and dominant market position, indicating the company can finance operations very cheaply. The structure of this low WACC is significant. The capital structure relies heavily on debt, which is 62.8% compared to 37.2% on equity. This high amount of low-cost debt helps significantly lower the overall cost of the capital. Moving to the pro forma results, the model confirms steady growth. We project net operating revenues will grow from 49.53 billion in 2025 to 63.92 billion by 2030. This consistent 5% to 6% annual growth suggests the core business remains strong. Crucially, our free cash flow to the firm analysis confirms Coca-Cola Company is rich in cash nature. The 2024 free cash flow to the firm was 19 billion. Our projection shows this cash generated while the firm grows steadily, reaching 26.33 billion by the end of the 2030. This cash flow supports both maintaining dividends and funding growth opportunities.
Now the results. Finally, combining our projected cash flow and the WACC indicative model, we arrived at our estimation of the intrinsic enterprise value. The valuation yielded an intrinsic enterprise value for the KO company of approximately $431 billion. This total value is composed of a present value of our discrete cash flow from 2025 to 2050, which equals $54 billion, and the present value of a terminal value, which is $377 billion. The terminal value, capturing the value of a cash flows beyond 2030, makes up nearly 87% of a total enterprise value. This high proportion is typically for a major, stable company like AKO's, highlighting a market confidence in its long-term stability and continued cash generation. Finally, the key takeaway and lessons learned. Our analysis confirmed that KO possesses a strong, stable, and cash-generating business model, which justify its high intensive valuations. Our main takeaways are twofold. First, the valuation is highly sensitive to input changes. We learned that the intensive value responds significantly to small changes in WACC and the terminal growth rate. For example, sensitivity analysis showed that 0.5% increase in WACC can reduce the intensive value by about 13.5%. Therefore, maintaining an optimal capital structure is crucial for KO's valuations advantage. Second, our recommendation to investors is that the current valuation is well supported and strong brand power and consistent cash generation. Investors should closely monitor the company's ability to maintain high margin and execute its diversification strategy. Future work could involve a more detailed market-based cost of debt calculations or implementing a three-stage DCF model to capture a potentially high growth phase immediately following our current forecast.